Liabilities are debts that a company has, either bank loans, mortgages, unpaid bills or any other sum of money that it owes someone else. Financial liability is an obligation, defined by previous business transactions, events, sales, exchange of assets or services, or anything that would provide economic benefit, at a later date. Liabilities are usually considered short-term or long-term. Along with owner's equity, liabilities can be thought of as a source of the company's assets. Assets are tangible or intangible items that a company owns, including buildings, machinery, equipment, accounts receivable, patents or intellectual property. If a business subtracts its liabilities from its assets, the difference is the owner's or stockholder's equity. Assets minus liabilities is equal to equity. However, in most cases, this accounting equation is commonly presented as assets are equal to liabilities plus owner's equity. This relationship is called accounting equation. Classification of liabilities. Current liabilities are liabilities that are due and payable within 1 year. Non-current liabilities are liabilities that are due after a year or more. Contingent liabilities are liabilities that may or may not arise, depending on a certain event. Let's have a brief look at 3 types of liabilities. Current liabilities. Current liabilities are a company's short-term financial obligations, that are to be settled within 1 year. These liabilities should be closely watched by management, to make sure that the company possesses enough liquidity from current assets, to guarantee that the debts or obligations can be met. Current liabilities are used as a key component in several short-term liquidity measures. Examples of current liabilities: accounts payable, interest payable, income taxes payable, bills payable, bank account overdrafts, accrued expenses, short-term loans. Non-current liabilities. Also referred to as long-term liabilities, non-current liabilities are debt or obligations that are due in more than a year's time. They are an integral part of a company's long-term financing. Companies take on long-term debt to acquire immediate capital to fund the purchase of capital assets, or invest in new capital projects. A company will face solvency crisis if it is unable to repay its long-term liabilities as they become due. Examples of non-current liabilities: bonds payable, long-term notes payable, deferred tax liabilities, mortgage payable, capital leases. Contingent liabilities. A third type of liabilities that may be recorded by some companies on their balance sheet are called contingent liabilities. They are potential liabilities because they depend upon occurrence or non-occurrence of some future events. They may or may not become actual liabilities. Examples of contingent liabilities: warranty of a company's products, the guarantee of another party's loan, and lawsuits filed against a company.